We are 7 months into 2026 and we're already seeing gains of 29% year to date. Honestly, I wasn't expecting to see these type of gains this year, especially after seeing gains of 43% in 2024 and 27% gains in 2025. So how am I doing this? 3 years in a row, I have very credible gains that even a hedge fund manager would be very proud of. In the beginning of 2025, I started this $100,000 challenge. Now, 19 months in to this 8-year challenge, well, we're ahead of my original forecast, $14,615. In fact, I've had to make small changes to how I track my progress. For now, all I'm doing is updating my annual gains from the previous year. This only adjusts the yearly targets, while my monthly milestones stay the same. The reason why I've done it this way is so I can still see my original forecast. And yes, we're doing very well at the moment and I do hope that continues. But as everyone knows in investing, there will be negative weeks, negative months and even years. So this is an attempt to keep my targets and milestones realistic. If they were too far ahead of me or too far below me, then it simply wouldn't work. For those that are new here, I'm not a financial professional. I'm just a dad keeping the system simple and documenting every win and mistake to reach $100,000 within 8 years. I calculated that with a monthly contribution of around $500 and a 14% annual return, it is possible. Not to worry though, if you have less than $500 to invest, then it'll just take you a bit longer to get that $100,000. Or you could choose to increase your risk and aim for a higher return than 14%, which could reduce your time. But honestly, I wouldn't recommend that. Time is your best asset. Now, if you want to follow this journey and see if I can actually pull it off, subscribe and hit that bell. In July, we saw about a 2% gain. A 2% gain might seem small, but that 2% keeps me more than on track to 14% annually. The main benchmark for all investors, the S&P 500, basically stayed flat, with a decline of 0.13%. Year to date, the S&P 500 has returned 9.41%. Historically, its average is around 12%. So it's looking good so far that the S&P 500 will hit its historical average of 12%. But as we mentioned earlier, we are absolutely smashing the S&P 500 with an amazing 29% year to date. In third place, we have Mastercard with just over 13% gains. Mastercard had bought back $4.9 billion worth of their own stock. This automatically raises their stock price, but with some analysts upgrading the Mastercard to a strong buy, the impressive earnings report, this meant that many investors wanted to buy into this dividend powerhouse. In second place was EOG with almost 14% gains. EOG is the largest independent oil and gas producer in the US, and when the oil prices go up, they can sell their fuel for a much higher profits. Investors were not disappointed when the latest earning report came through, reporting $2.8 billion in free cash flow, coupled with EOG's pledge to distribute 70% of their free cash flow to shareholders. But the fluctuating oil prices does mean this sector is more volatile than usual. And in first place, Microsoft. After their last month, their 25.55% gains were very welcome. Last month, investors were left worrying about their massive spending in the AI infrastructure. But with spending kept under control by being limited around $175 billion, yeah, I know, very in control. At the same time, producing record-breaking earnings in Azure, taking it over $100 billion, $90 billion in revenue, and paid seats for Microsoft's 365 Copilot jumped 50% in just 90 days, up to 30 million users, proving to Wall Street that customers are eagerly paying for the AI tools rather than just experimenting. And third from the bottom, FedEx Freight. With a decline of 7%, the forecast given by FedEx at the end of June fell short of Wall Street's expectations. And without earnings report yet, it seems like some investors are getting impatient and selling off their shares from the split. Second from the bottom was IBM, with just over 19% decline. Even after massive gains we saw last month from the excitement and quantum computing, the early unexpected earnings fell short of Wall Street's expectations, and the CEO also said that there were some failures due to deals not being closed on time. To me, this looks like a classic hype trading, lots of excitement, then lots of panic. And at the very bottom this month was Caterpillar, with a 20.56 decline. After them reaching all-time highs in June, many institutional investors locked in their profits and sold shares. Also, analysts downgraded the target price from an outperform to neutral. It's not bad news for Caterpillar, in my opinion. It's quite common to see a slight pullback after record highs. Now, the dividends, one of the most important parts of a dividend growth strategy. Now let's look at what's been paid in the portfolio and where the reinvested dividends and monthly contribution went. Dell, EOG and Omnicom Group provided the bulk of the $21.17 dividends this month. There were only 6 companies paying out this month, but there's still good cash flow being generated. In July, I bought 10 positions in single stocks, with most of the money going to ABBV, CVS and Caterpillar. The intrinsic value calculator identified that my average share price was way below the intrinsic value, so that's why there's more invested in those 3 and the other 7 positions were equally invested into, which is good because this helps keep the portfolio balanced. Continuing with my latest decision to no longer actively invest in Bitcoin and dollar cost average into the gold ETF and an all-world ETF excluding the US VEU. We finished July sitting right at $14,615. The system is compounding. The reinvested dividends and the intrinsic value buys are flowing. What did this month teach us? It's a reminder that the stock market will always test your patience. When Microsoft dropped last month, panic was high, and when it surged 25% this month, the narrative flipped just as fast. The same goes for Caterpillar, cooling off after hitting all-time highs. If you chase the hype, you'll drive yourself crazy. But if you rely on the intrinsic value, ignore the short-term noise, and focus on the long game, the results take care of themselves. If you want to see how this portfolio holds up next month, make sure you're subscribed. I'm Steve Williams and I've been the Dividend Dad.